Hi everyone, as well as our online audience. I just wanted to welcome everyone to the Michigan University's Ross Alumni Club event on crowdfunding, VC, and capital raising. Where's it all headed? So I'm Shelley Trolley, but you guys haven't met me yet. I'm the founder of Investors Beat, which is a publication for real estate investors. With myself being a real estate investor as well as being an entrepreneur, when the Ross Alumni Club approached me to moderate, obviously I was very fascinated by the topic. So as the title of the event suggests, the availability of credit and how to access these lines has changed significantly, particularly in the last, I suppose, 18 months or so. And those of us who are building a business as well as real estate investors can really capitalize on this change. So tonight we've actually got 4 speakers, and how the night will actually run is each of those 4 speakers will get about 20 minutes each to do a presentation on their topic. Each of them are specialists, experts in their field. They either raised funding themselves for their own investments or their own business, or they've done it for a range of businesses. So I'm really looking forward to that. So we will have a networking break at about 7:30 p.m. for about 20 minutes, and we'll wrap up about just before 9 p.m. We're hoping by the end of the night, our online audience, as well as you guys, will sort of get a little bit more of a feel about the obstacles as well as the new opportunities available in crowdfunding and capital raising. So the first person I'm going to really get up on here is really Manolis. So Manolis is just to my left. I'm just going to pull up his bio. Manolis, I'm not going to even try and pronounce your last name. How do you pronounce your last name again?
Spinorilakis.
Spinorilakis. I'm going to blame it on my Australian accent. So Manolis graduated from the University of Connecticut with a Bachelor of Business Admin and a concentration of accounting. After 2 stints with Deloitte, and as well as himself being, in the restaurant space and real estate and internal audit, he identified a unique opportunity to create Realty Crowd TV. Worldwide small businesses through crowdfunding. So he's really an expert in the crowdfunding space, and to provide a blueprint on how they can crowdfund their own businesses and projects. So welcome, Manolis.
Excellent. Just give me one moment while I enable the content, and we'll figure this out. 1 second.
There's your technology.
Excellent.
My name is Jay Moore. I'm the managing director at Farmers Capital, and I went to the University of Michigan. So I wanted to thank all the people that are here in person and all the people that are on the webcast. We have a great line of speakers, all the prospective students. We really hope that you consider the Ross Business School at the University of Michigan. It's a great business school. Any alumni that you want to talk to will say the same thing. So with that, I'm going to turn it over to Manolis when he's ready, and I'll continue talking. So basically the finance track here at Ross Business School, we do 4 events per quarter. We did an event about 4 months ago on the credit crunch of 2008 and what took place past. And so we try to focus on topics that are really topics that are tied to things that are going on every day in finance and financial innovation. So just like Shelley said, we set things up here so that we'd have 4 experts on their subject, but also time at the end for people to talk and the people that are here in the room to ask questions and also online. So Manolis, whenever you're ready.
Sure. There is some technical difficulty with the PowerPoint presentation. I'm just trying to figure that out, but I can get the presentation.
No, what we'll do is I'll actually go first. So what I'm going to talk about is traditional financing. So what I do is I provide strategic advisory service to companies that are raising money. So to make it very simplistic, you have a startup, so we cover healthcare, high tech, commercial finance, and real estate. So I'm going to really talk about is traditional financing when it comes to non-real estate projects, because we have people here that just focus on real estate. So first thing I want to say is just a quick walkthrough of my background. I graduated from Amherst College in 1994 with a degree in economics and psychology. Then I went back to Ross Business School in 2000 to study finance, mostly here in the Boston area. Farmers Capital is a year and 2 months old. We currently have 5 clients, and all the clients are here in the U.S. Okay, so when we're talking about capital raising, we're talking about sort of non-crowdfunding financing. There's 2 categories. So we have the debt financing, then we have the equity financing. On the debt side, your sources are really commercial banks, commercial finance companies, leasing companies, doing a M&A transaction where you're buying a company that has a lot of cash, and that was really big in the late 80s. You don't see that as much. Also, one category which people really don't think about is getting money from either state, local, or federal governments, or one federal government here in the U.S., obviously. But that's important because there's a major push now to create jobs. So if you're a startup and you can make the case that you can create jobs, there's job programs out there. They'll either be tax incentive programs for you or grants. So that's a category that a lot of entrepreneurs overlook because they think that they can't get money from the state government, local government, federal government for their project, but that's not the case. I actually used to work for the U.S. Department of Commerce, which I know that firsthand. Okay, so the main people here probably are more focused on equity capital. So when you're talking about equity capital, you're really talking about the first category would be private investors. They're high net worth individuals or family offices. If you're very wealthy, you'll have a family office that actually manages your money. So they invest in startups, they invest in real estate. The main challenge there is just getting into the family office, right? It takes time to get to know people. That they have a lot of deals coming through there, but that's one category. It's much easier to raise money from from high net worth individuals. Dan's going to talk about this a little bit about what he's done on the real estate side of things, but really what our focus is at Farmers Capital is really going out to high net worth individuals, understanding what their criteria is for their investments, which takes time as well, fostering those different relationships. And what I'm doing is I'm providing advisory services to the client on how to approach that investor. That's a very important distinction because if you aren't a registered with the SEC broker-dealer, you can't sell a security. And if you're raising money for a startup, you're selling securities in that. So it's very important. Something that the SEC has really cracked down on since 2008 because, so there's 2 categories. There's a finder, and that category is where someone's going out and finding people for that entrepreneur to invest in, but they're not actually actively involved in the process of selling that security. So in practicality, what happens is most of the conversation is being led by your client, the entrepreneur, as opposed to you trying to sell them on it. You're really there to put them in contact. Very important distinction because if you violate that, if it's an SEC violation, you're selling a security when you're not a registered broker-dealer. Very important, and it's something that the SEC is currently cracking down on. So the next category is doing a broker between the client and a institution. So that institution could be a venture capital firm, could be a hedge fund. Really wouldn't be a private equity firm when it comes to a startup. But using the One of the things we all hear about and know firsthand about what's going on overseas, right? There's a lot of money in China, Dubai, India, and that's something that, because you're doing a cross-border transaction there, there's things that you want to take into account. It's more complicated. There's different laws. There's different political risk potentially for that investor than here in the U.S. So that's very important as well. But it's a category that you have to think about, correct? Because there's so much money overseas right now that it's a great source of money for your clients. Next category would be strategic investors or corporate venture capital firms. So companies, for instance, one person I know well is someone that works at Qualcomm. Qualcomm's based out of San Diego. They're big on making chips in the cell phone industry. Well, they have a group there that actually funds startup projects that they think fit into their strategic interests, but that they can also make an economic return on. Your startup through a corporation who has a group inside that makes investments. That's one source as well that's growing, because it's much better now in some cases to buy a technology than it is to try to develop it in-house. Those are really the main sources of capital. We'll have time at the end to ask questions, so I'm going to turn it over next to Manolis, who's going to talk about crowdfunding.
All right, everyone. Give me one moment while I figure this Google Hangout out. And I think I got it. All right. And Shelley, where's Shelley? Would you be able to perhaps progress my slides for me?
Of course.
Awesome. All right, so I wanted to say thank you all for coming. This is a great event. I got to say thank you to Jay. Jay organized this event, and Jay is a great guy. We're all very excited to be here. And I also want to say thank you to the audience online. One of the comments left on the thread was Manolis is a crowdfunding genius, so I appreciate that comment from my friend Steven. My name is Manolis Manorilakis, the founder of Reality Crowd TV. And the mission of our company, if you could fast forward a little bit, the mission of our company is to inform, educate, inspire, and motivate entrepreneurs worldwide to start small businesses through crowdfunding and to provide them with a blueprint on how to crowdfund. So a little bit about me. I'm a former Deloitte & Touche auditor. I started my career at UConn, graduated and went to Deloitte. Left Deloitte, did real estate, property management, and leasing for a year and a half, rented about 75 apartments in a year and a half, went back to Deloitte for 11 months. My family opened a second restaurant, and it was failing, so they were at zero revenue, closed it down. I came in 7 months later, we sold it for $150,000. We still lost money on the deal, but they didn't lose their life savings. Came back, the Hartford Insurance Company picked me up as an internal auditor, operational auditor, and that's when the fateful day came. October 23rd, the Securities and Exchange Commission released a press release about crowdfunding. Now, as far as the people in the room, how many of you know what crowdfunding is? Okay, so a good amount of you. So for those in the audience who may not know, let me just break it down. Take the concept of passing around the basket at church, where a crowd of people contribute to an individual with a need. Put that concept online, apply it to creative projects, tech projects, small businesses, just about anything, and you have crowdfunding. So the current model that most people know about is the Kickstarter model, which is a for October 23rd, is actually as a result of the 2000. Who are hearing about this for the first time, write down 2012 Jobs Act, because it's important you know. In that act, they released provisions for equity crowdfunding, equity and debt crowdfunding. So you had three specific provisions that were very important for you to know. Title II, Title III, and Title IV. Title II allowed for general solicitation of accredited investors through crowdfunding. Prior to this, you were not allowed to generally solicit accredited investors. But now you're allowed to generally solicit accredited investors through internet websites that do crowdfunding. That's a huge change. Huge change. Now, Shelly, I'm going to take a risk, and I'm going to ask you to play that. I don't know if it's going to mess up, though, so let's try it. Hopefully it won't. But I'd like you to play that because it really explains what Title III is. Oh.
Whoops, I did.
Actually, hit escape for a minute.
Escape.
Yep. Oh, all right.
Enter again.
Actually, use the mouse to click on that icon. Actually,
Which icon?
the PowerPoint.
I actually can't
Okay.
see the PowerPoint. Sorry.
Okay, never mind then for now. I'll just explain it. So, Title III equity crowdfunding. This was released on October 23rd. It is lifting the requirement since 1933 that you had to be an accredited investor to invest in a private company. They're lifting the requirement that you have to be an accredited investor, which means an individual who makes $200,000 a year or is worth $1 million in net worth, excluding your personal residence. In America, currently, there's only 8.7 million Americans who qualify as accredited investors. They are lifting that requirement and expanding it to 300 million Americans to help raise capital for private companies. Huge. Absolutely game-changing. Now, of course, they have protections. If you make under $100,000 a year, you can only invest $2,000 or up to 5% of your income for a total annual investment of $5,000. So in other words, a janitor who saved up $50,000 over a lifetime cannot just dump $50,000 into one of these investments, right? So they have safeguards. The regulation was 585 pages long. So they have enough in there to make sure that people are not going to be taken advantage of. Additionally, if you make over $100,000, you can invest up to 10% of your income, up to an annual cap of $100,000. So this is a very interesting development. I mean, a lot of people are getting excited because there's just certain individuals who will never put a donation in exchange for a reward. Ultimately, they want a return on their investment, so they're not just going to put something into a Kickstarter, right? How many of you have ever donated to a Kickstarter campaign? So about 10% of the people have ever donated to a Kickstarter. Now, what I want to share is what are the benefits to startups, because my presentation was crowdfunding and startups. What most people don't realize is crowdfunding is a plan. You must execute a plan to appropriately raise the capital you need. Right now, the success rates on Kickstarter are 43% of people who put their projects online get funded. But that was much higher. That used to be 60%. I mean, 43% sounds like a great number still, right? I mean, that's pretty good odds, but it used to be much higher. It used to be 60%. Now that people are hearing about it, they're doing what I call let's hope for the best syndrome. So crowdfunding leads to hope, hope leads to action, and currently action leads to I have a great idea one day, and a week later I'm throwing my project on Kickstarter, and I'm hoping for the internet angels to come down and save me. Unfortunately, it doesn't work that way. Successful projects take 3 to 6 months of execution. It's a marketing and communications plan that ultimately builds you enough momentum to reach this very specific milestone. If you can reach 30% of your funding within the first week on Kickstarter, and I mentioned Kickstarter because they have a lot of analytics. If you can hit 30% of your funding goal within the first week on Kickstarter, statistics show you have a 90% chance to raise the rest. Why is that? These sites, like Kickstarter and Indiegogo, they have these algorithms that if there's a lot of traction on your crowdfunding campaign, your fundraising page, they will put you on the front page of their site. There's over 4,000 active campaigns right now on Kickstarter. So okay, 7 viewers still on. For the viewers out there, actually, let me see if you see it.
You should make sure how to work this, just in case.
Yeah, this is just just curious to see. They did it.
Yep, that's right, man. Oh yeah, the mock dinner we had with Jeff. Jeff did the spin on we need another exclusive.
It's really crowded, that's good to know. It's very handy for our partnership stuff. Try. I don't. Yeah, I live in New York now. I used to live 10 minutes away. So I love Boston. I speak do a lot of overseas investors there. Yes. Okay, so it's for music bags, that's alright. Yeah, cool. No, that's great. I love hearing.
A few more minutes, everyone. Again, I apologize for the technical difficulties.
Sure. Well, Dan is about to start with real estate section. Real estate. Obviously, Brian is a crowdfunding platform called Crowdfunding. So we're very lucky to have him because it's one of the top crowdfunding platforms nationally. So actually really but yeah, that's how we found out about this event. I pretty much, I've been real estate invested for about 8 years now. I used to work in corporate, I used to do business development and marketing. So that was my background, and I really wanted to, I thought I was going to invest in something like this. My reputation is real estate investments. So right now, we're really helping real estate investors including customers, including so I started off really just wanting to help investors and me really help educate them. Things like this, Dan did great online as well. So his presentation is actually very inspiring. So I really got started by being an investor first, very much being a real estate investor, and then made a little bit of money and decided to start my own business. Because I always wanted to start my own business at some stage. And yeah, there's not really much to it. I really just decided on something that I really enjoyed doing. Real estate and real estate investment, meeting people like Ruben, for example, like really collaborating with the population. Yeah, so we pretty much we're an online publication. So do you know Inc magazine? Yeah, or Entrepreneur magazine. Okay, it's just an online magazine for investors who have a website, and it's just a whole bunch of content for investors. So yeah, really helping them how to buy better, how to make some money with real estate, including things like EBITDA, crowdfunding, That's my house. Yeah, but you can find.
Yeah. Yeah. No, it's fine. Yeah. This thing that we normally never started. You guys.
I was just gonna say, I just myself in
You guys sit down with this stuff back on. Last time we saw it's called trying to start company stress. Sure about this is a good one.
You're an athlete.
That's what everyone says. So this is who we.
Yeah. Someone knows there's a lot of things. I don't know if there's people sign up and I need to send it over to Chris first in the morning. So we can send it around. You have
I should learn how to do this.
You guys can find out who's actually on the webcast.
Yeah.
Can everyone take their seats again? We're about to get started.
Okay, before we start our next session, is mic working?
Yes, just push on.
So before we start, I just wanted to turn it over to Jim Hanley, who's our president of the Boston chapter. He's done a great job I've been involved since I came to Boston in 2000. It's amazing how much the program has grown since then, and Jim's been president the entire time, so he takes full credit.
Thanks, Jay. Oh, sure. All right. Again, as Jay said, I'd like to welcome everyone tonight on behalf of Ross Boston. You know, we have a large community. We have a modest community within the Ross Business School's alumni base here in the New England and the Boston area in particular. But we actively hold events. Generally, we have an event monthly in the spring, and in the fall we kind of take a little break around winter time, and then break over the summertime. And we just try to get like-minded people together. We try to get controversial topics going on, and so please, and now that all of you've registered to be on our email list, and so you'll be aware of all the events that are going on. And we also participate in a cross B-School alumni club, if you would, where it's, there's about 25 top 10 schools. You know how the business schools work that way, and so there's a couple of dozen B-School clubs that all have groups in the Boston area that get together for like happy hours once a month. And so I encourage you to pop out for those. It's the second Tuesday every month. I believe we're holding them at the new Ritz down. It's not the new Ritz anymore, but the Ritz.
The Taj? Is it the Taj?
Is it the Taj?
In Boston, Arlington?
No, that's the old Ritz, but I believe we're at the new Ritz, kind of over by the theater district over there. And so those are great events, great networking, and it's not just Michigan people, but I know we don't have just Michigan people here anyway. So it's a great chance to get out and do some networking and meet other folks. And one of our Ross board members of the Ross Boston Club is actually kind of the chief. She's the queen bee of running those events and helps organize those. And usually you can go out and meet like this, 30, 40 people, just all kind of out having a cocktail and enjoying the time, passing business cards and talking shop. So it's a great opportunity. And again, we'll see. We'll take a little bit of a break. I think we're probably going to have an event over the summer to welcome a lot of the students and recent graduates. We have a lot of interns that come to show up in Boston. Boston's kind of a hot destination for interns and graduates. So we'll come out for those, and we'll have a happy hour and meet and greet sort of thing. And then we'll get ready back with our fall events. Shashi's going to run an event for us probably in September, October timeframe. Heavy entrepreneur bent to it. It'll probably be a small, kind of more intimate setting, maybe a dozen or so people who have dinner talking about some interesting topics. And we also have the former Ross School Dean, Bob Dolan, who's back at Harvard now, will be giving a talk with us on a marketing topic, nothing to do with kind of MBA stuff in general. He's kind of, I think, probably trying to move on from that after doing 10 years in Ann Arbor. But he's got a really cool topic on a marketing topic. He's going to give a talk for us in the fall. So, and then we'll be meeting, if you're interested in the board, please see me afterwards. We'll be meeting for, probably in a month and planning out our next year's worth of events. And we're always open to ideas. A lot of the events come from people who come to meetings and say, hey, you guys should do this. And we're like, have at it. Please join us. So again, thank you all for coming tonight. We have some great 2 more panelists, and we'll have a chance to mingle again afterwards. Welcome.
I just wanted to say one more quick thing before I turn it back to Shelley. We have had a lot of help marketing this event. I wanted to help the various business schools that Jim mentioned, but especially Harvard, who sent the invite out to 8,000 Harvard MBAs. So that was very helpful, both getting people online, but also people here in the room. So thank you so much for that. I'll turn it back to Shelley now.
Okay, so the real estate section, area that I am really looking forward to. So Dan Botwinick is our next speaker. He's the principal of Cougar, right? Is that the right title? Cougar Capital Management, and has made a full-time career in real estate investing by syndicating deals and redeveloping distressed apartment buildings throughout Massachusetts. He's been the principal on 50-plus transactions, operates with a portfolio value of $25 million, all within the last 6 years. He's built a property management company to service these apartments, and his construction arm oversees the development of assets. So, welcome, Dan.
Thank you very much, Shelly. So I know very little about crowdfunding, so like everyone here, I'm excited to learn a little bit about it tonight. I think I was asked to speak here because I can give you guys a little bit of a counterpoint in terms of sort of some of the aspects of raising capital traditionally. And my presentation tonight is geared sort of in two parts. Firstly, to talk a little bit about some of what goes into raising capital traditionally, and I'll just give you guys a little bit of an introduction to sort of how I got started. And then the can funds. Thank you, notes would be awesome. So I guess just to get started, if you can skip forward a little bit here. Perfect. So this is how I got started. I was 24. I wanted to buy a place, and I wanted it to be something that would give me an introduction to being a landlord, to see whether or not it was something that this was the place that I found and thought made sense. If you keep going, I have like 40 slides, so I'm going to be churning through these pretty quickly. So this is my first attempt at real estate development. I am renovating my own bathroom. I think this was a Tuesday night at midnight. My friend and I, my roommate and I, were basically ripping apart the bathroom and realizing that that there are some consequences when you do that, like not being able to have a shower or a bathroom for a while. So I realized that the real estate experience was something I liked and I was excited about, but not necessarily being the guy that actually did all of my own work. That I'd probably find more competent people than myself to do some of that. So as I got into it, and I'll spend a little bit of time on this slide, as I got into it, I realized that it was something that I did want to do. I did want to make the transition from the corporate world into real estate and investing in development. And so I apprenticed myself to a guy who was raising capital and investing in office assets around Boston. And these are some of the things that I've kind of taken away in terms of what to do when you're raising capital traditionally. So from my experience, to actually get into the business of getting a deal done, you kind of need a couple things to happen at once. Primarily, it's both finding a good deal as well as having the means to close on that deal at the same time. And I think the really challenging thing for a lot of folks who are getting started is that often you might have that really good deal, but you only have a limited window in which to be able to act on it. And conversely, you might have some investors that you've spoken with and they're kind of interested, but then their interest or ability to actually fund a deal might not be there at the same time as you actually have that deal that comes together. So the key is really being able to put both of those things together at the same time to get a deal to come to fruition. And so a few things that I found is that in terms of being able to actually put all that together, some of the things that go into being able to have a presentation, talk to folks, and be able to raise capital sort of in this traditional way. It's not so much simply having finding a deal, but knowing how to really understand whether or not it's going to be a good deal. And there's a lot that goes into that. Certainly more than I'm going to try to get into in detail. But in terms of what makes a good deal, it's not simply looking at the property on the surface, but really getting into the due diligence. And one of the lessons I've learned is that it's definitely better to walk away from a bad deal than to actually be able to close on what's maybe a good deal, but maybe a marginal deal. If there's one thing I've learned, the deals that I've done that have been good have been very good in some cases, but the deals that I've done where I had some kind of nagging doubt or suspicion going into them, in some cases those have cost me so much more than the deals that I've done that have been good. And so I've been lucky in a lot of ways, and in a lot of ways all of those deals, even the ones that I've had to really work hard on to get through, have taught me a lot. But if there's one thing that I've learned, it's that it's really so important to do due diligence at sort of a very micro level to really get through that. So in terms of sort of communicating with investors and finding investors initially, having a clear business plan is really key. It's not enough simply to tell an investor, that, you know, if you invest with me, here's how I think you'll do. You're going to get a 20% return of your money. You really need to have a defined business plan so that you can communicate to them what you're going to do with their money, what's going to happen with the property, you know, what the best case scenario might be, but what a backup plan might need to be. And then, you know, what's the exit of the deal? How are they going to get their money back? And, you know, what is their return likely to be in different cases? And so you really have to approach each deal as its own business and have a business plan for it. And that's something that I think is, you know, sometimes if you're just looking at investing in a two-family, for example, it may seem like overkill, but really putting that effort into the due diligence and the presentation and crafting those materials, I think, is what can set you apart from other folks that are trying to do the same thing. And you know, it's definitely important to have persistence. You know, for I guess a personal note for me in raising capital, sometimes some of the folks that I talked to originally and might have showed a deal to weren't ready to invest at that time for whatever reason. Perhaps I was too new to them, or I didn't have enough of a track record, or perhaps they didn't have liquidity at the time. But in being around for a while and having a couple successful deals under my belt, was able to, you know, show them how those deals worked out and build some credibility over time and build a track record. And that's what is helped me to get more capital down the road to kind of continue doing more deals. So a few notes too, I guess, just about you know, that sort of general discussion will help you get your first deal done. But after that, and really what's so crucial about if you want this to be something that you do kind of as a career, it's not just about getting the first deal done, but it's about doing a really good job with the deal once you have it done. Because if you don't, and if you're not good at not only managing that deal, but also communicating about the progress of that deal and what's going on with it to your investors, then you're not going to have satisfied investors. And so it's really important and that you're good about communicating not only the good things, but also the bad things, the setbacks, the challenges, so that your investors have confidence that, you know, you're going to do everything you can to make the deal go smoothly, and if there are hiccups, that you're upfront about what they are, and you know, you're going to be a credible partner in working through those. So I guess just to finish on the last point, so especially if your deal isn't something that's straightforward, but if it has a significant amount of management in construction or repositioning, that's where it can get really hairy. So I guess with that in mind, yeah, if you mind else. Sure. Thank you. So just again, I'll kind of move quickly through this, and then my plan is to spend a bit of time on this case study of a recent apartment complex that we purchased to redevelop. So this is the first building I bought in 2007. I left the corporate world, apprenticed myself to a gentleman who kind of taught me the ropes in terms of putting deals together and raising capital, and was finally able to put my first deal together in 2008 in an 8-unit building in Fitchburg. And that year, I was able to raise capital from another 9 investors and ended up finishing the year with 57 units. I was doing mostly REO portfolios I was buying at that point from banks and trying to cluster them in particular areas. And so my investors, the folks that I was getting in front of and were interested in investing, and again, it's a very different economy in 2008, they were not interested in buying things that had significant appreciation potential in really nice areas. They were interested in buying stuff that had cash flow. And so I was looking in areas that were going to be management intensive and require a lot of work and a lot of management. That's why they gave me their capital to let me work really hard in those places to try to generate a return. And so that really informed my strategy. So this is what I was doing when I guess. I love the thing. This was I found this just parking lot in Quincy. It's out there, and my buddy and I he was nice enough to help me load those toilets into the back of my mother's Subaru. So that was one of the things that I did, among many other things, to try to do whatever I could do to get these properties to provide a return. In hindsight, this was not a good strategy. Definitely better to buy low-flow toilets, especially in areas where water bills are high. And in some of the cities I invested in, the water bills have gone up significantly. So over time, I've certainly learned better. But just to give you an example, when you're getting started out, anything that you can do to save money is is something that you can't think that you're above in order to make things work. And just kind of a quick sense to kind of show you how the last few years progressed. Bought a bunch of stuff in 2008, and then 2009 I spent kind of figuring out how to manage that stuff and building a management team around it. Again, bought quite a few things in 2010, kind of doubled the portfolio from there, got up to about 150 units, and then spent a lot of time sort of again digesting that portfolio in 2011. The bookkeeping and kind of really focusing more on the core operations in 2012 that set me up to grow significantly in 2013. And today we're a little over 400 units. Minnows, if you would. Keep going, please. So what I'll talk about in the time I've allowed, 10 minutes or so, or okay. I'm going to talk about a property that purchased in Fall River in February of last year. So just to give a little bit of context in terms of sort of how it started, how I got here. Primarily, I was buying smaller deals, 4-family, 6-family, maybe an 8 or 16 unit building. But this was a property where, with one particular investor, we've been able to do a number of deals and successfully refinance them to the point where he was able to cash out on most of those cash flow properties, where he was able to get most of his capital out. And one of his interests was in doing a larger complex and something where there's some value-added component. So this is actually a deal that I've been working on for almost 2 years at the time it finally closed. A lot went into putting this together, and very difficult seller to work with. But without getting too much into the background of actually closing on this deal, mostly I'm kind of going to talk about sort of what we did once we bought it, and hopefully it'll be of some interest to you guys. So this is a property we purchased. It's these 7 or 6 different buildings in Fall River. Fall River is a pretty tough town. It's about 50 minutes south of Boston, and it was hit very hard by the recession. Has quite a high unemployment rate. So when we purchased the complex, the average rents were about you can keep going through it. Average rents were about $600 per unit, and there was a very high vacancy. The seller had not really fixed up the units when they became vacant. We just kind of shut the door and leave them closed. So you can keep going, please. So this is kind of just the before of the property. We purchased it for $1.85 million, a little bit under $27,000 a door. 66% occupied. There were a few things that I really liked about it. One was that it was built in '87, so anything built after '78 doesn't have lead, and that was a huge plus for us. The utilities were separate. It had pitched roofs, and a lot of those things lead to it being in much better in terms of an operational standard, in terms of keeping down the operating expenses. But there was significant deferred maintenance. One of the buildings was a tear-down condition. Had a very bad reputation for crime and drugs. But it did have the fact that it actually had tenants paying. There was about $25,000 a month of rent coming in at the time. So these are the just a sense of what the units looked like before we did a renovation. Keep going, please. So just a few picture slides for you guys. So nothing fancy, but pretty good size and a reasonable layouts. This is the property that was in really tough condition, 201 Cove, and this is just been boarded up. So we had 2 options as we looked at it. We were buying the property for $1.85 million. my typical model had had been up until this point. I need to buy something that I can buy it and put enough capital in that when I'm done with it, we can operate it and no one would confuse me with a slumlord. That was basically sort of that's the minimum that I want to do when I own something. And so the approach to put in at least enough that you're going to kind of be a reasonable operator. I budgeted at $300K. We weren't going to, the units would look generally the way they looked in the before photos, but they would all look like that. We wouldn't have a bunch of units with, kitchens missing, and we improve the landscaping a little bit. We fix the stuff that needed to be fixed. Basically, we'd make the complex a serviceable, reasonable complex. The rents would maybe go up a little bit, but not too much, and they'd be going up through better management and kind of getting rid of the tenants that were obviously committing crimes. And that was sort of the first approach. The second approach was a little bit more daring, and we budgeted putting in about $1.2 million to do over all the units and really kind of improve the complex, new kitchens, new flooring, and spend some more money on the exterior. And so if you scroll down a little bit more, in kind of the rough numbers of what we're looking at, the average rents were $600 a month when we purchased it. If all 70 were occupied, we'd have gross rents of about $500,000 a year, and at a 60% or 40% expense ratio, about $300,000 in net operating income. So at a 10 cap, that might be a valuation of about $3 million. And so again, sort of in my typical approach, I would look to be all into something for about 75% of what it would be worth. That would enable me to get a loan for 75% loan value, and theoretically cash out the investor. So with option A, we could be into the property for $2.25 million, based on our $1.85 million investment, and assuming we got it to appraise out at $3 million, potentially we could achieve a cash out. And option B was going to be to put in significantly more capital in order to, again, achieve that cash out, which is, in this case, this is something that's important to my investor to be able to do. We need to achieve a value of $4 million. So to get to that value of $4 million, we need some combination of a higher net operating income and also a justification for a lower cap rate. And that was a big question for us in deciding what we're going to do with this property. If we did pursue option B, would the $4 million valuation really be there at the end of the day? So those are some of the questions. And then also in terms of considering our exit, not only would it appraise out in a refinance scenario, but what if it didn't appraise out? Would a buyer pay that price, or they pay at least enough that we could get our capital back? And what would the return on investment be in each scenario? So that was sort of what we were looking at as we looked at this. By a show of hands, just in terms of you guys, it's always interesting to see kind of the appetite of the crowd. How many of you guys would have been more interested in pursuing option A at this point? And who would have gone with option B? Okay, so we'll keep going here. So these are some of the questions that we wanted to ask in terms of trying to make that decision. And some of these may be things that you were thinking of. So some of these have to do with what's the immediate neighborhood like, who lives and works nearby. How easy is a city to work with? Are there maybe to work with? Are they going to make us install sprinklers or incur other major expenses in terms of getting the property to be improved the way we want? And will the operating expenses increase? What are they going to do for the taxes? Will the assessment go up? And then finally, what rents will the property support? What are the other apartment complexes in the area able to charge? What are the other 3 families that are closer to us able to charge? And where are we going to fall in terms of the rents that we actually achieve? The quick math for us is that every $100 per unit increase across 70 units is going to translate to an additional $84,000 per year in net operating income. Or again, at a 10 cap, $840,000 about. So if we could achieve rent increases, it was really going to create a significant difference. I'll go pretty quickly through this just for time. But again, just in terms of putting together a typical pitch, this is some of the research that we would do and package for investors. So did some background on Fall River, looking at where it's located, other developments that are going on in the area. Keep going here. Possibility of having a commuter rail extend down there, and looking at comps of other properties that traded nearby to help us kind of justify where we were. This is a property that traded for $70,000 a unit. That was about 2 miles from our property. Had some things that were comparable, but in some ways a superior location. But the rents were a little bit higher. So ultimately, this is what we chose to do. We ended up going with option C, which was an even higher construction budget. And we basically, at this point, we've fully executed on it. We're leased up. The average rents are about $800 per month. And our sort of our pitch to people that are potential residents coming in is that we can offer them granite and hardwood floors, but for less than $1,000 a month. So we're attracting not as much folks that are from Fall River, but really folks that are commuting maybe from Providence, maybe they're going to Boston, nurses, various other folks that are kind of in a market for perhaps not luxury living, but some of the amenities that they might look for without being in a position where without saying it.
Come towards the TV.
Sure. So we're attracting folks that are interested in having some of the amenities without a price tag that makes it difficult for them to justify. And so actually this slide's a little out of date, but I think we're actually at 96% occupancy, with the exception of the 40 in the building that we're actually getting funding through the city to renovate, and the property ended up appraising at $5.3 million. So if we can continue on. So here are a few before and after photos. So this was the complex actually before we purchased it in 2011. Here's what it looked like in October. We've actually made some significant changes since then as well, but we just keep going through here. We'll just go kind of through these pretty quickly. So these are some of the exterior improvements that we made. And yeah, just keep on going through. So we added, I'll pause here for a second. So just so you can kind of see the evolution of some of these buildings. So one of the things that I think detracted a lot of folks, or detracted from the complex itself, was the color of the siding. So the cheapest way to change the largest amount of square footage was to change that siding. So we ended up using a gray color. We changed all the windows. We also added these dormers and porticos, and really kind of changed the sort of the look and feel of the complex to be honest. Set up our storage system. Just kind of keep going through here. These are the common area renovations that we did. And here's a typical photo of one of the kitchens that we ended up with. Living area. And we can just keep going through these. And then actually, so we'll pause here. So I just took these a few days ago. So this was, now kind of how we've ended up. We still haven't, in this picture, done the seal coating. There are a couple more things that we're kind of finishing up now, but you can kind of see where we ended up. So if you do, just scroll through the last couple here. So we actually took out a little bit of parking. We were able to create some more in the rear of the complex, but put in some landscaping that's been really well received by the residents. We're putting in a laundry room with some new coin ops, and that's about it. So I'll just say these are kind of extra slides. So without saying too much more, that was basically the renovation. I wanted to share with you guys that case study. And I guess
Questions?
yeah, at this point, just opening up if you guys have any questions about this project. Sure. Sorry.
You said you had some city funding also to help with the renovations. How did you go about getting that city funding? Can you just quickly talk about what you did to prepare for that?
Sure. So in terms of attracting capital, there are a lot of different sources. I've worked with different cities in the past, and sometimes it can add a lot of red tape to the process. In this case, I had a meeting with the mayor, and he introduced me to their community development officer, and they had funding, and they wanted to use it to do projects. The project that we had was a good fit for their program. And so in this case, it was a matter of convincing them that we knew what we were doing, and we were agreeing to have a slightly we have some affordability restrictions in this particular property that we're going to do, but they'll only apply to that 4-family. And in this case, given the area and the market rents that we're looking to achieve, we're really not going to have to take much of a haircut in terms of the rents we can actually charge. We'll end up having a 1% interest loan that will amortize over 25 years and will subordinate to the financing that we'll get in first position. Actually, if we refinance, it'll subordinate again to our lender. So it really puts us in a nice position. It allows us to get our LTV a little bit higher at almost a 0% interest rate, and we don't have to pay more out of pocket to get this particular property turned around. So we'll end up paying a little bit more for the overall construction project, but paying it back at 1% money, and enable us to complete the project without more capital out of pocket. So that was basically the determination to use that funding source. Yeah, in the back.
What did you finally close at, the purchase price, and also what was the equity split that you and your partner you decided on, and how did you reposition? How did you go from having a low income to maybe a mid-income type property? How did you reposition and market that? What was that process like? How long did it take?
So I think that was 4 questions. I'm only going to allow 2, but no. We ended up closing at $1.85 million. My typical fundraising model has been to offer basically a 50-50 equity split. So on whatever value is created, the simple way of explaining it is that we split that 50-50. But I take all the risk of the capital, and I'll sign personally on the loan. And depending on the project, there will be a preferred return to the investor on their capital, so they're going to get some interest on what they're putting in. In terms of, I guess the last part of your question, which again, would you say it again? But basically, how did we decide what we were going to do?
Well, how did you reposition a property from, you basically had low income tenants, and then you reposition where you had maybe middle income, because we were saying you're marketing to people who might commute to Boston, possibly to Rhode Island. How long did that take, and what was the strategy to make that happen?
So that gets into a lot of what we spent a lot of our time thinking about and trying to learn about. I knew at the price that we paid per door going in that it was going to be a good deal, and so I was less worried about deciding on the answer to that question at the outset, which made me pretty comfortable going in. But over time, it was something we really wanted to figure out before, certainly before we spent $2 million, we wanted to know that the property would support that. So the initial plan had been to spend $300,000 going in. Based on our research, I got comfortable spending closer to $1 million. And then based on how well things were going, and also based on what we thought the delta was going to be between the type of folks that we were able to get, or that we took over when we initially bought the property, and the type of folks that we realized that we were able to attract and the rents we were able to achieve, that made us comfortable spending that much more money. So a lot of that extra money went into the exterior and other things that, again, helped us further attract even a higher clientele. But initially, I underwrote the project thinking that we'd be able to bump the rents from $600 to $700, maybe $750. And so when we were able to sign leases at $800, and some actually are at $850 a month, that really, that justified an extra $1 million in appraised value, which obviously justified significant additional spending. So, as a developer, it's fun to spend money. It's fun to have a really nice product that people want to live there and they want to enjoy it, and everyone likes it. But as an investor, you want to make sure that you haven't overspent on something, and so that you're not going to be in trouble. So the question is, how do you find that sweet spot? If you're, ultimately for my investment in this particular project, as long as we're able to cash out, maybe not right at the refinance, but within a few years after that, that was his benchmark for success. And so we were able to get comfortable that the appraised value would be there, and also the cash flow would be there, that we could spend more money and still be able to achieve a level with the project where the the rents would justify the additional amount that we'd spent. So that was basically our analysis. As we went through it, we done some renovations. We found people were willing to pay more. Initially we were signing leases at $750 a month, and people were saying, "Gosh, I'm not going to rent with you guys. I'm going to rent over here for $850 a month because I don't like some of the cars I see in your parking lot." Or when I was doing a showing, I got a weird feeling from some of the existing residents who had. And so we went from so we actually bought it with a hard money component. Initially, we were going to buy it with conventional financing, but given the significant vacancy and the fact that the lender that we were actually working with had another portfolio actually go into delinquency in the same city right as we were going through our process, we ended up having to, in order to close on this, we needed to get hard money at the last minute. It actually ended up, originally we were going to close on the property at $1.9 million with the understanding that we'd be able to get conventional financing. The hard money was going to add another $100,000 to the total project cost, and so we were able to get the seller to agree that since we couldn't get conventional financing, we were still going to close, but he had to split that with us, and that's how we negotiated another $50,000 off the price at the end. And so we almost lost the deal again at that point, but I think it was the right decision, and in hindsight, it obviously worked out well for us. In terms of the debt, we, at that point, would have been able just to proceed with the financing we had in place. We did end up then putting conventional financing on the property based on the appraised values that came in recently, and then we structured that where we actually sort of have almost a bridge loan with our existing lender where we're getting, so we actually ended up buying another 39 units next for this complex, and that enables us to next project. And then once we meet certain hurdles in terms of showing lead certificates, actual occupancy percentages, signed leases, environmental contingencies being met, and management prepared financials at various hurdles that will release sort of the full amount up to 70% loan value. So that's how we negotiated or structured our debt in order to taster on most of the equity.
And your personal plan?
I've put a fair amount of time into the project. A lot of it is finding the right people to actually do stuff from the project. I pull a lot of permit managing specific, actually a couple days a week, but have people on the ground that do a lot of it. So I'd say this has been maybe 10 to 15 hours a week for me. In terms of, and a lot of that's property management or showing up in housing court over the last, since February when we actually closed on it. Can I turn it back over to you, Shel?
Yes.
All right.
Thank you very much. So our final speaker for tonight is Brian Daly. Now, his product really marries two of my big passions, technology and real estate. So very much looking forward to this presentation. So Brian is the co-founder and CEO of Groundfloor, the nation's first and only micro-lending platform for real estate open to all investors, not just accredited funds. Brian has a 15-year career building disruptive technology, everywhere from startups in Silicon Valley, Boston, London, and North Carolina. Take on their carriers to international acclaim, and as a result, more Americans can afford a smartphone. And this is a long list of credentials here. Harvard Law School, MBA from Harvard Business School, and a BA with high distinction from University of Virginia. I'm not sure when you get time to sleep. So I'll hand it over to you, Brian.
All right. So, you take the microphone for a second. Need something?
We just wanted to thank you very much for paying for the flight to come here because it wasn't in our budget. We appreciate it very much.
Well, you're most welcome. I love to come to Boston. It's awesome to be here. I think there are some slides up here. Am I standing in the right place? Let's see. Good. Wow. So let me just get a show of hands because I can balance what I'm about to say between a couple of different topics. Among you, who here came really to hear about crowdfunding? Just generally, crowdfunding for your startup, crowdfunding for small business. That's more what you're into. Yeah. And then who among you, I know a couple of people that I talked to before, really thinking about real estate in particular and sort of want to know what was happening in that category. A couple of you, right? The interesting thing is you're both going to be happy because there's a movement afoot in crowdfunding real estate. Talk about what that means, what that is. That it turns out, when the people who are working on federal legislation that would make equity crowdfunding for all, for the 98% of wealth holders and income earners in the United States, that when it would make it legal, right? It's still not, right? It still hasn't come to pass at the federal level, as I think we already discussed earlier. When people were working on that, the thought was that it might be for tech startups or for the next Facebook, right, to give everybody an opportunity to get on the next Facebook or the next Google. There were some people who thought that it would be better suited for small business, for example. Almost no one was thinking that real estate would be the breakout category. Almost no one. And yet real estate has funded about $100 million here in the US worth of crowdfunding projects on it's a misnomer really to call it equity crowdfunding because a lot of it is frankly debt crowdfunding. No one really thought of that, and yet it's been the breakout category. So a lot of people who are interested in crowdfunding generally have sort of become real estate guys because real estate turns out to be an asset class that's performing really well. And I think as we look forward to small businesses and perhaps medical treatments and many other asset classes and categories that I think can and will be funded by the web. People are looking at real estate as sort of the first category that's taking off. So you're both going to be happy. At least I hope that's true. Hold me accountable to that. And afterwards, if it's true, come give me a high five. And if not, let me know I didn't deliver. So give me the first slide, and let's see where we go here. Yes, this term, crowdfunding. Just by a show of hands, how many of you guys have heard of Realty Mogul or any of the other companies up here? You know, that's pretty good. They've attracted a lot of press, not the least of which reason Realty Mogul managed to raise a $9 million Series A recently. Fairly impressive accomplishment, having raised at the time only about $20 million in loans. Remember that ratio, $20 million in loans and a $9 million Series A. You got to figure that's probably about a $31 million valuation. Very, very interesting. That number 31 I just picked out of my head because everybody thought that was amazing until just last week. How many of you heard of a company called Fundrise? You know what that is? Yep. After
how you could have heard of it if you're looking at the space. 31 million. The problem is that all of these people, and I'm friends with them. I'm friends with Jillian. I really respect what she's done there, and I've met Ben Miller, and I think that a lot of these companies are doing great work. I think we need to take a look at this word crowdfunding, especially because real estate is the first asset class. We're the soul. Funding projects and crowdfunding was originally meant to be. Give me the next slide. We're very concerned about this. So I don't know whether those items are crowdfunding per se or not, but we all know what crowdfunding is when we see it, right? So Kickstarter, obviously crowdfunding. Kiva, crowdfunding. Indiegogo, the folks in Indiegogo love to talk about how actually it's them, not Kickstarter, that it's the largest crowdfunding site in the world. They battle it out, but they're both great, right? They're both great for what they do. These are crowdfunding sites. What does that mean, right? I actually have a 3-part test for what crowdfunding is. And I will be the first to tell you that ground floor fails it. All of the companies on the first slide fail it, and there's only one company that actually meets it. Right? There's only one company that is really the Kickstarter of real estate crowdfunding out there. It's not us. It's actually Fundrise. That's what they're doing, right? They're bringing social capital, right, to the capital stack for a portion of their deals. Now, it turns out that Fundrise is doing as much business. They're doing a ton of business in the accredited investor platform that I think also fails, probably by a measure of 35 to 1, right? Their business fails my definition as well. And here's the definition I offer you. It's crowdfunding, first of all, if, I think everybody needs this, if it's a mechanism. Crowdfunding is a mechanism. It's some people have said even passing the You know, and the types of questions we got, right? Yeah. Quite obviously, they're either, you know, it's not that you could just really tell that this wasn't like a sophisticated real estate investor who'd done this before, had a lot of money. There were a lot of $100 investments, right? I'd say, you know, over a third of our investments were less than $500. So only one investor actually has sought accredited status on our platform, and that's just so that he could break through the $10,000 limit that Georgia imposes for annual investment under their laws.
So can anyone nationally invest, or do you have to be a Georgia resident or any restrictions?
The question is, can anyone nationally invest? So most people in America don't know that there are a broad swath of very profitable investments that you're not allowed to make. That you are, 98% of the people in America, literally, you are not allowed to, actually, until this recent law passed, under very stringent circumstances, you couldn't even hear about these investments. Not only could you not make it, you couldn't even know about it, right? That's how locked down, right? Securities laws has been since the Great Depression, and I think Manila said it well, the internet can actually change that, and it is changing, right? So the answer to your question is, can everyone in the country invest in Ground Floor's investments? No, because Ground Floor is a young company, and we have a roadmap to get there. I think, you know, my prediction is by this time next year, everyone in the country will be able to invest in Ground Floor's investments. In fact, all of you who live in Massachusetts, I have good news for you. This summer, you'll be able to invest in Ground Floor investments. So we have received approval from the state of Massachusetts, which is why I was willing to fund my airplane ticket here. We've received approval in the state of Massachusetts to offer Ground Floor investments starting this summer. So you'll start to see, in fact, we're lining up our first projects here. So if you know real estate developers who do our kind of thing, right, which is this kind of residential product or ground-up town development done as well. We're very interested in knowing those people, and we want forward thinkers, right, who are willing to kind of go through the pain of a new technology and be a good early adopter and help us make it happen, right? They're really partners more than their customers. So it'll happen in Massachusetts this summer. We're adding states throughout this year, and I think next year will be national.
When it happens here in Massachusetts, will it then be limited to only Massachusetts investors?
So the question is, when it happens here in Massachusetts, will Massachusetts people be stuck in investing in what you don't want to invest in Massachusetts?
But let's say about a New Yorker, someone from New York, or Connecticut wants to
the way that we've architected this is pretty amazing. We've already jumped to the last slide. It's okay. We'll revisit it when we get there. But under this offering, the way that we've engineered it, actually, we've been approved in 5 states now, so that people in those 5 states can invest anywhere in the country. So if you'd like to invest in John Mangum's next project this summer, you can do that from Massachusetts. And if somebody in Atlanta, Georgia sees one in Boston that they like, they can invest in that. And we like that because we don't want people to sort of put all their eggs in one basket. We want them to make their own REIT. We want them to diversify, right? Yes?
So what's different legally or regulatorily from what you're doing in Lending Club, which is just a lot of huge?
Well, first of all, the question is, what's the difference between what Ground Floor is doing and Lending Club? Why would Ground Floor be allowed to do this and Lending Club not? Well, first of all, the most important thing is we're not lending to consumers. So our loans are made to effectively small businesses, LLCs, right, that are doing this business. So it's adjudged not a consumer loan, a non-consumer loan. So that's number one. So that eliminates that. The way that we're operating, we're not regulated, which is helpful. And then we are availing ourselves of securities laws that, were they not hamstrung by the other two, one or both of the other concerns here, they would probably be able to offer their product here.
It's a consumer finance regulations they have here.
I'm not sure with respect to Massachusetts in particular as applied to Lending Club, but the likely suspects are consumer finance or banking law, or both. Yeah, we're not subject to either of those. More questions? Yes.
How do you make money?
We make money the same way that any good intermediary does. We charge the borrower an origination fee. for a while. There are a couple of others. It's happening in a lot of industries. Pretty much any. I mean, you just have to ask yourself, what's a good asset class for the masses, right? For us, we like real estate because it's tangible. We like debt because everybody can understand it. You know when you're getting your money back, and you know how much money you're getting, right? Fundrise, as good as they are, they're selling a product that's kind of hard to understand, right? I mean, they're selling a preferred stock product that, if you're a real estate guy, is not intimidating to you. But a preferred stock product, you don't really know. It's an indeterminate time period to get your money back. The dividends are determinate, right? That's good. But equity can go to zero. It does.
Can I take that question too?
Yeah.
I mean, I think this question of, can someone who's, let's say, an artist, can they look at a high-tech company and go through the same process that a VC firm goes through to figure out if they should, can they look at the competitors, can they look at the marketplace, can they know if there's a kid in China, thinking of the same exact product there. And I think that's a risk, because what's happening now, if you're trying to turn individuals into a VC firm, I think it's very risky, and I think that's one of the risks of crowdfunding for that model, right? And he talked about these two types. There's the ones that you're an author, want to publish a book, you go into Kickstarter, your fans give you money, but then there's the one where you actually want to make a return off of it. And to take, the average American or average person and to try to put them into a role of a VC firm, I think is very risky. Like his business model, when it's real estate, I think it's different, right? Because you're talking about a very confined space, but you don't have to worry about that. The person in China, right, might come out with the next high-tech product that knocks you out. But I think, looking at various industries, I was a syndicated credit research analyst for Bongo Sand there for RBS. Right, so 100 hours a week, I was just looking at companies doing that. If someone hasn't had that training, it's very difficult to do. So
actually, can I just respond?
Sure.
So I think I have to see what you mean, and I have to see other things going on. I'm thinking, like, what if you could have a website for the arts that was like Kickstarter, but
There is. It's called Arty.
it's Kodati, and
There's a whole stack of them.
yeah, okay, so or for technology or whatnot, where the investors aren't actually venture capitalists. They're not people who are part of that group investing. They're just people who are seeing this online or being moved to that online. And is that still a risk?
Yeah, so let's look at the movie industry, for instance, right? Because we've all heard that there's been actors that have Spike Lee raised a lot of money on there.
Reading Rainbow.
So if someone's looking at investing movies go into to make money, and you don't have the skills and you don't know anything about the movie industry, it's very risky. I mean, people in Hollywood, right? There's studios in Hollywood, do 4 films there, figure out which movie's going to do.
Yeah, I guess I mean, people aren't talking about funding these things. Doing it from standpoint, but would be doing
in my opinion, when you dominate a niche and provide ancillary services, for instance, there's a crowdfunding for authors right now, pubslush.com. They have publishing experience, so they're providing specific ancillary services for that niche. If you can provide a similar service for artists or technology companies or, I don't know, any kind of category, you can create that dominant space. And in fact, a lot of people think the Kickstarter model may not be the best model. Some people see that everything to everyone will not end up making it. Brian, I know you have a lot more slides too.
I don't.
So yeah, so let's.
No, I don't have a lot more slides.
I was disrupting,
But
I'm sorry.
no, you're not disrupting. I love disruptors.
Who needs technology when you have?
Yeah, disruptors are my favorite people, so that's good. But I will tell you, there's a philosophical point that you raised. Actually, there's something.
It's something I've been trying to do myself.
There's something under the surface here that people don't really think about or talk about very much, but it's very important at a conceptual level. It's are people smart enough? It's the Stuart Smalley question. Are people smart enough to be venture capitalists? And that's a fine debate. I will plant myself firmly on the side of saying they are. I think people are a lot smarter than we give them credit for. I know a lot of venture capitalists. They're all very smart people, but there are different types of intelligence. And the web is big enough, broad enough, and free-flowing with information enough. I'm just an internet bigot, so I'm an internet ideologue. So count me on the side of thinking, yeah, the hive mind is going to figure it out, right? And if you build a good enough mechanism and you break down the barriers and impediments to allow that to happen, it will happen. And if you don't, because you're scared, you have to protect people or out of some form of paternalism, then it won't happen. And then
Someone else will do it.
Yeah, someone else will do it.
And Brian, what do you think about syndicates of unaccredited investors? That's an idea. If unaccredited investors will soon be able to invest, maybe they'll align themselves with a company that has a great track record, and they'll say, well, now that I can invest $2,000 a year, I'm going to go to the Goldman Sachs of unaccredited investing, and I'm going to trust you with this money. It opens up a whole other.
What I'm telling you is that human beings are very good at organizing and communicating. That's what we're good at doing, and the internet just magnifies that, right? It's humanity writ large. So I think, I think that's what God intended, and I think that is going to manifest itself, right? If syndicates make sense, if we just, I think the libertarians partially had it right. Just get out of the way and let the information flow. It's going to happen.
Can I respond to that too?
He's got another question. Okay.
Wrap it up.
Okay, we'll wrap it up. So one of the things, going back to sort of this point, can an investor have the same success rate or good success rate as a VC firm or someone that's experienced? You also have to keep in mind that if you're dealing with a VC firm or someone who's helping you raise money, you have two screens in place, right? That VC firm chose to take that client on board as a client, and then they've already raised the money, and they're choosing to give that money to the firm. So you have a screen that's there, right? You have these people who are working 80 hours a week at VC firms, analyzing, looking at deals. They know the industries, they know the markets, and they're choosing certain ones to give money to. When you're talking about crowdfunding, that wall's down. There's nobody in there who's trained at that, going in there and saying, this firm, I think, in the high-tech industry, from all the players throughout the world, this one company here is going to make it. And I don't fully see it, so I do disagree here. Just to say it bluntly. How can someone, right? It's just like, if someone asks me to, figure out which of these 100 movies will be a big one, I don't know, right? I don't spend 100 hours a week doing that. How can someone who doesn't spend 100 hours a week, has been doing it for years, analyzing companies, real estate deals, right? How can a real estate investor, sort of, have the same skills that Dan has? Dan's been doing this for years and has a track record. I think that wall coming down is really one of the risks of crowdfunding. I think there's a place for it, but I think it's a major risk.
So I have to respond to that. On behalf of the internet, I have to respond to that. I have to. It can't be allowed to stand. Because the fact is, most venture capitalists, dude, are not good at making money. That's the dirty little secret.
They make a lot and they lose a lot.
Well, the dirty little secret is that VC as a business, and most people who are in it and honest with you will tell you it's not a sustainable business. It's just not. Except for a very narrow segment of winners. It's like claiming that somebody who is a pro athlete, right? Well, it's like pro athletics, really. I mean, the numbers are very similar to like Major League Baseball or football. And I'm just telling you, the vast majority of these professional investors who went to Harvard and are so smart and work 80 hours a week, they don't make money at it either. right? And by the way, those guys who are making money at it are often making money because of selection bias, right? And because of feedback mechanisms, right? It's not through merit. It's not. In a lot of cases. In some cases, it is through merit, but in others, it's not. And I'm telling you right now, ask angel investors, how much money they make. These are wealthy, sophisticated people.
We wanted to say hi to other prospective students throughout the world. We had someone from Sudan who said that they were dialing in. Thank you so much. Consider Michigan. If you have any questions, talk to alumni. They're very passionate. We put on great events like this. So thank the panelists so much for coming. Thanks Shelley for doing a great job moderating.
Good. Thanks, everyone. So I always end every broadcast with our kind of like a theme. So until next time, dream it, believe it, achieve it.
All right.
Very similar to mine. Great. Build your world. Or